welcome everybody. Today is obviously Friday. We're here to learn, right? This is our Learning Friday, okay? So we're going to talk about a few things. Okay. Hi everybody. First of all, my name is Jimmy. We're gonna go ahead and dive right into today. We're going to talk about how banks work. Okay, that is our focus for today. How bank work. Yes, you understand how bank really works, but there are ways you can avoid just putting all your eggs in one basket. Okay, the banks are not the only thing out there, y'all. Especially the fact that they're not even giving the most interest rate on whatever savings you have with them. But let's go ahead and dive right in. We're going to talk about US and Canada, okay? Because obviously veracity, we're out here in the US and of course in Canada. So if you have friends and family in Canada, of course, maybe out here in the US too, that needs help, you can of course send them our way and we can help you guys get more financially literate and get more education, okay? Enough of me talking. Let's keep going. Now, how banks work. The US, let's start with that. What is a bank? I mean, obviously a bank is you literally walk up to it and you can open up a checking and savings account. You can, save money in there, but it serves as a crucial financial intermediary, okay, in the US, okay, in our economy, connecting people who have money with those who need it. That's literally the bottom line of what a bank is, okay? Just connecting people who have money and people who need it, and from there. Now, of course, when you deposit your money into a bank, you're essentially you're lending your money to that institution, okay? In case you did not realize, that's what you're doing. Why do you think they, have this whole rule of 25%, $25 monthly fee or something if you don't have like $500 at least in those kind of accounts, There are multiple avenues that banks make revenue, right? But the major part is the fact that you putting your money in there, you're lending them your money. Guess what they do? They turn around and loan that money to people as, credit cards. And you get the point. We'll get to that point. So yeah, like I said, you're lending the bank your money. The bank then uses that deposit to provide loans to other people, to other customers. Okay, so like individuals buying homes, guess who's giving them loans? The bank does that, right? Student financing education, right? That's also another avenue that they do give money out. They give loan out, to other customers. And even businesses, like, when wanting to expand your business operations, guess who you're going to? The bank, right? They're not giving you their own personal money. They're giving you other people's money, They understand the game of when it comes to OPM, other people's money, okay? So yeah, they're in the game of that. So I mean, the role of a bank is fundamental to how, this is fundamental to how banks really generate revenue, okay? So let's continue. Now, what do banks do? Okay, what banks do? I mean, they accept deposits, okay? So they collect money from depositors, including individuals, businesses, government entities, right? Now, this deposit form the foundations of how the bank lends out money. Okay, so the more money you deposit into their savings and checking account, they can then turn around and use that money and loan it out to people. Okay, they do pay interest, right? It's really minutia. It's like 0.001. If you'll be lucky if you find like really high yield interest rates bank accounts. But at the end of the day, reach out to whoever invited you here because they can even point you to directions, right? That's the whole point of this call too. So yes, banks do pay interest, okay? So they compensate depositors with interest payments for allowing the institution to use their money, right? That's why you tend to see like 0.01 interest every month. And guess what? You got to pay taxes on those interests you get from the bank. And then of course, banks also make loan, right? Duh, they do lend the money you deposit to qualified borrowers, okay? Now, those borrowers would in turn pay back the loan, right? That's what they call principal. They pay back the principal over time plus interest, okay? I mean, obviously the loan can range from like mortgages to auto loan to business loan to even personal credit, like credit cards, okay? And yes, they do charge fees. That was the other side of what I was talking about earlier, where they do make other source of income, revenues. So they charge fees like service fees, monthly account maintenance, Even overdraft fees, they charge those too, including ATM usage, wire transfers, several avenues that the banks do use to make money outside of just the deposit that people are putting into those institutions, into their institution. Okay, let's continue. Now, this is just showing us the average bank account interest rate. Okay, this is to tell you that in America, in the US, a regular savings account will earn you about like 0.41% in interest. Okay, that's really ridiculously nothing. Okay, reach out to whoever invited you here. They can really point you to other directions that would help you, right? Um, Even with a normal checking account, there's like a, what is it, average of 0.07%. Okay, a CD, like a 1 year CD is more of a certificate of deposit. It's kind of like you lock your money up for like a year or 3 years or 5 years, depending on whatever it is you choose with them, right, with the bank itself. An average percent when it comes to the interest rate for a 1 year CD is like 1.8%. Okay, a 3 year CD is like 1.3. You get the point. It's not as much. It doesn't really earn you. This does not help with compound interest, which is what I will preach every day of my life. Okay, you need to get yourself into a financial vehicle that earns you a lot more with compound interest compared to what a regular bank does. Okay, but this is just to show you that average bank account interest rate is not really where you want to put all your eggs. Okay, it's not gonna get you to retirement. It's not even gonna take you through retirement. Okay, you got to be thinking about that too, y'all. Okay, let's continue. Now, there's something called FDIC, okay, in America. It's called Federal Deposit Insurance Corporation, okay? This really just provides, protection for your deposit. And there's a limit. The limit is $250,000 per depositor, per insured bank, per account ownership, okay? So if you, let's say, have like a specific account with, let's say, Bank of America, and I hope Bank of America doesn't go out of business. But my point is, you put like $1 million in Bank of America and they go out of business. Guess what? You only get $250,000 back. Okay, that's how much FDIC insures. That's it. Okay. I mean, FDIC was, established back in 1933 during the Great Depression. Okay, this is just to help, build the trust in the banking system back then. Okay, I mean, obviously, it's been almost 100 years at this point. It's 2026. So yeah, they've been around for a minute. Okay, so the FDIC insurance does apply to all account types, like checking, savings, money markets, okay, CDs, those are certificate of deposits. Okay, now I will say the FDIC does not insure anything that's related to theft. Okay, it does not cover anything related to fraud. It does not cover anything related to investment losses like stocks, bond, mutual fund, crypto. Even if you purchased all of those through your bank, they're not insuring that. You're on your own at that point. Okay, so bottom line here is FDIC, it's a Federal Deposit Insurance Corporation that will insure your money in a bank account, in a banking institution, but only up to $250,000. Okay, let's continue. Now, let's really go dip down into how the bank really works, y'all. Okay, we're gonna, get in the weeds here. Now, first of all, you're a client, right? You put your money in the bank, right? Guess what happens? I mean, FDIC does insure your money only up to $250,000. Okay. Now, I want you to pay attention to the fact that the I in that FDIC acronym is literally called, it's insurance. Okay. Federal Deposit Insurance Corporation. Okay. It is insuring your money. Okay. So they insure only $250,000. Now, guess what the bank does? The bank turns around. I mean, yes, they do loan out the money, right? But they also turn around and put it into an insurance policy. Okay, guess what? When they do that, before they go on to the insurance policy, they turn around and pay you, interest, like I was talking about earlier, the 1.001.07% in interest rate that they give you back. But guess what? That is taxable. Okay, so whatever it is you get back is taxable. Now, going back to the fact that the bank then turns around and take your money and also put it into an insurance policy, that is really making them a lot of money. Okay, so you putting your money in the bank, it's kind of a 1 to 10 ratio. Okay, but then putting the money that you put in there into an insurance policy, that's a 10 to 1 ratio. Okay, they're making like 6 to 12% in interest. I want that to sink in. The fact that the money you put in, they take it and put it into an insurance policy, and that's making them 6 to 12%. But then they turn around and give you like 0.001 or zero point 0.1, in interest. So it's like they're making it's just a steal. Okay, it's a no brainer. So, and when they get those 6 to 12% interest back from the insurance policy, guess what? It's tax free to them. They don't got to pay taxes. Whereas you're out here paying taxes for the 0.001 interest you're getting back from them. Sorry, it's just this whole concept is funny to me because it's like when you understand this, it's like they're making money from your money, like I said, other people's money. So all this whole concept I just mentioned is what we call BOLI, bank owned life insurance. Okay, so that's pretty much what they do when it comes to making money with your money. Okay, outside of the credit cards that I mentioned, like loaning people out, loaning money. Now, what you really want to do is cross out the bank. Okay, take the bank out. Okay, and you go put your money directly into the insurance policy. Okay, because then you are now at a 10 to 1 ratio. Okay, now you're the one making the 6 to 12% tax free interest. Okay, that's where you want to be, where you are the one controlling all of that instead of the bank, like, making money off of your money out of, I don't even want to say triple rate, like quadruple at this point rate. So yeah, this is what we call infinite banking. Okay, infinite banking, where you are bypassing the bank, you're putting your money directly into an insurance policy that's making you a lot more money, and you can go back and even borrow from it if you wanted to, and you're making 6 to 12%. I'm yet to see a bank account that would that would give you a 6% interest back on your money. I'm yet to see one. Okay, but yeah, so this is what we call infinite banking. Now, on here, I do want to point out, there's a book called Money, Wealth, Life Insurance. It's a very small, tiny book. You guys can read it in like 30 minutes if you want, if you're a fast reader, of course. And you can even get it on Spotify and, read through it in ASAP. But my point being is, on this slide, we can see, 4 banks on here that have life insurance assets. And guess what? Majority of the money in there, it all started with other people's money, right? They have all this money in their reserves. Of course, they have to put it somewhere that's making them a lot more money. As we can see, Bank of America on here has about like 19 billion. Yo, I read this book back in 2022. I'm sure, well, it's 2026. I'm sure 19 million has gone a lot more higher. Okay, 19 billion has gone a lot more higher for Bank of America. Okay, Wells Fargo is about $17 billion when this was published. So my point being is, banks know what they're doing. Okay, so you got to play the game that they're playing. Okay, don't get played by them. Play the game they're playing. Okay, go put your money in a vehicle that's going to earn you a lot more compared to what they're giving you at the bank. Okay, let's continue. Now, this also kind of shows us, banks ranked by life insurance asset. Obviously, Bank of America takes the crown, right? This was I think this was published 2024. I was looking for the date. So yeah, it was published 2024, right? So like I said, 2 years from that day, it's definitely gone up. So they have about $24 billion in life insurance asset. Bank of America specifically. Wells Fargo has about $18 billion. And this is a B. Okay, I'm not saying million, B. And it's gonna keep going because they understand the game and the power of compound interest. Okay, they understand that a lot, like a lot better. So yeah, you want to play that same game is my point here by showing you this. Now, remember how I was talking about the Federal Depositor Insurance Corporation? Federal Deposit of Insurance Corporation. The FDIC, they do insure $250,000, but this slide just shows us the fact that banks do fail. Okay, yes, the one that really I can't even get it out of my mind is the SVB bank, the one that failed in 2023. Banks are still failing, right? Even since then. But my point is, banks fail, okay? And when they fail, guess what? You can only get just what I said, the $250,000 from the insurance at that point, right? So it's like, do not, I mean, trust the bank to pay your bills, right? But don't trust it to like for your investments is my point, because they do fail. Like, okay, they also then fall back on their insurance policy, which also can bills them out in that sense. Okay, so yeah, let's continue. Now let's talk about Canada, y'all. Canada, that's another beautiful country out there. So yes, I mean, how banks protect your money in Canada? It's called, their insurance is called Canada Deposit Insurance Corporation. Okay, CDIC. This really does serve as the government agency that's responsible for protecting eligible deposits at member institution. This was established 1967. Okay, so about like 30 years after, almost more than that. The one, excuse me, this was established 1967, almost 30 years more than, after when FDIC was implemented. So CDIC in this case does provide automatic coverage, okay, without requiring customers to apply or pay additional fees, okay. Now, CDIC, I mean, obviously it does apply only, it activates in the event of a member institution. So whenever you have a bank account, a credit union, or a trust company, like whenever all of those fail, that's when that insurance come into place. Okay, now CDIC doesn't cover theft, it doesn't cover fraud, it doesn't cover unauthorized transactions. Okay, I mean, this situation required different protections and, of course, immediate reporting to your financial institution. Okay, and CDIC only covers $100,000. That's it. It's a lot lower than the U.S. like FDIC coverage, but CDIC only just covers $100,000 Canadian dollars, of course, per depositor, per insured categories, per member institution. Okay, so multiple accounts in different categories can each receive separate coverage, obviously. Different categories, emphasis on that. Okay, let's continue. Now, types of deposit covered by the CDIC. I mean, obviously, it's very similar to, the FDIC, but in Canada, it's savings accounts, your checking accounts, those are covered, okay? If you have a guaranteed investment certificate, those are also covered, right? Other term deposits, okay? So that is definitely also covered under CDIC in Canada. Now, types of deposits not covered. I did point out the other on the other slide. So fraud, theft, definitely not covered. Stocks, not covered. Mutual fund, not covered. Bonds, not covered. Cryptocurrency, absolutely not covered. ETFs, not covered. Okay, so what this is really telling you is that any of your investments that's in the stock market is not covered. Okay, because guess what? FDIC and CDIC, they understand the fact that the stock market is a roller coaster, y'all. It's a up and down game. So they're not going to cover something that's not guaranteed. Okay, they're not going to do that. So just, pointing that out for you guys to understand. Let's continue. Now, I mean, the average bank account's interest rate in Canada, I mean, it's not that much of a difference, right? So interest checking accounts is like 0% interest rate. You're not even earning jack from that, right? A regular savings account is about 2 to 3%, high interest savings accounts is about 3 to 5%, okay? And this is really based on the market and the year, okay? Just keep that in mind. Now, of course, they do have GIC, which is very similar to CDs in America, in the US, right? So GIC, a 1 year GIC has about 2.5 interest rates. This is an average, y'all. Keep that in mind, okay? Of 2 year, 5 years, it's about 3%, 3.7%, okay? Even tax-free accounts will earn about an average of 1 to 5% interest rates. Okay, let's continue. Now, banks and insurance leverage. I mean, obviously, you want to understand the strategic benefits when it comes to this, right? So there's, the area of risk reduction, right? So cash value life insurance does provide collateral, which reduces lending risk, okay? Another benefit would be capital creation. I mean, banks do generate loans and earn interest with a solid backing. The FDIC, they've been backing them for like almost a century at this point, right? Long-term planning, that's another benefit, right? So it serves as a strategic financial instrument for decades, right? This is when you are trying to use banks and insurance as leverage, obviously. Another benefit is tax efficiency, right? So growth is tax deferred, okay, creating additional institutional assets in that sense. Okay, let's continue. Well, that is pretty much it. Thank you so much. I really appreciate it. Okay. Thank you guys for listening to me talk about how banks work. Because, I mean, obviously, you really need to understand what it really means to, to putting your money into a bank account, right? They're doing several things with it. They're giving it out. What? They're not giving it out. They're loaning it out, right? Through credit cards. And we all know credit cards usually has like interest rate of like 26%. I think that's ridiculously high. Why would you want it? That's expensive money, y'all. Why would you want to get into credit cards? But they do that. They loan out money in that sense, right? And then they turn around and also put the money into an insurance policy because they understand compound interest. They understand the game of using other people's money to make more money, right? So you want to be in that mindset. You want to be in that space, okay? Well,